This week we are continuing with the corporate level strategies, and we will be looking at acquisition and restructuring strategies. So at the end of the lecture or the unit and tutorial, etc., you should be able to explain the popularity of mergers and acquisition strategy in firms competing in the global economy. Discuss reasons why firms use an acquisition strategy to achieve strategic competitiveness. Describe 7 problems that work against achieving success when using an acquisition strategy. Name and describe the attributes of effective acquisitions. Define the restructuring strategy and distinguish among its common forms, and also to explain the short and long-term outcomes of the different types of restructuring strategies. So, we're looking at the opening case in the 13th edition of the textbook, and it speaks about technology giants' acquisition strategies and their outcomes. So, online social networks such as Facebook have caused Procter & Gamble to relocate their advertising resources away from television to more digital formats. When Microsoft announced that it would acquire Skype Global, the leading internet telecommunications company, for $8.5 billion, there were more positive and negative. There were both positive and negative attributions about the deal in the media. Because Skype was founded and headquartered outside the US, Microsoft was able to use cash that was not repatriated into the US to pay for the deal, and in so doing it avoided paying US income tax. The Skype investment seems to be a bargain. The $8.5 billion represents a cost of $14.70 per customer. Comparatively, when Skype was bought by eBay in 2005, it paid $45.60 per user. Some challenges with these technology giants acquisitions: whether Microsoft will be able to utilize the service and integrate it into its focus on business customers relative to the consumer focus of Skype is a major challenge for them. Also, whether Microsoft will be able to incorporate the Skype service into its various devices and software platforms could also be a challenge. So if Microsoft did not buy Skype, it may have ended up in the hands of competitors such as Google, who might be able to use it to strengthen its ecosystem at the expense of Microsoft. But as an offensive strategy, Google's acquisition strategy is usually to acquire earlier stage companies than Microsoft's deal to acquire Skype. Google purchased YouTube for $1.6 billion in 2006. Facebook has a somewhat different approach to acquisitions, having recently purchased Snap2. Snap2 provides application software for services such as Facebook, Twitter, and LinkedIn, which allows these services to be featured on phones. Facebook has made 11 acquisitions since 2007. However, almost none of the acquired companies' service has survived as independent businesses. Online commerce is moving into a consumer-oriented retail phase, of which firms such as Facebook and Amazon are seeking to take advantage. Acquisitions are a quick way to move into the space that these tech giants see evolving, such as Microsoft seeking to broaden its communication base, and Google expanding beyond search to experiment with new models of advertising, and Facebook's attempt to learn from the human capital that they are able to acquire. So now we're going to talk about the popularity of merger and acquisition strategy. So mergers and acquisitions are quite popular in the US and has been so for many years. It is a source of firm growth and above average returns. Some believe that mergers and acquisition strategies played a central role in the restructuring of US businesses during the 1980s and 90s, and that they continue generating benefits in the 21st century. Mergers and acquisition strategies are heavily influenced by the external environment. Sometimes there are tight credit markets, or there are political changes in foreign countries' orientation towards mergers and acquisitions. During the recent financial crisis, tightened credit markets made it more difficult for firms to complete mega deals, that is greater than $10 billion. Then US deals picked up in 2011, where first quarter deal volume rose 45% to $290 billion, and compared to the 200 billion in 2010. Also, cross-border acquisitions heightened during currency imbalances from strong currency countries to weaker currency countries such as the US. Firms use M&A strategies to create value for all stakeholders. Merger and acquisition strategies, value creation applies equally to all strategies: the business level strategy, the corporate level strategy, the international strategy, and the cooperative strategies. M&A can be used because of uncertainty in the competitive landscape. It increases market power because of competitive threat. It spreads risk due to uncertain environments. It shifts core business into different markets, and it manages industry and regulatory changes. The intent is to increase the firm's strategic competitiveness and value. Historically, returns are close to zero, so it rarely works as planned. Mergers and acquisition value creation is challenging. The good news is that shareholders of acquired firms often earn above average returns from acquisition. The bad news is that shareholders of acquiring firms earn returns that are close to zero. In 2/3 of all acquisitions, the acquiring firm's stock price fell immediately after the intended transaction was announced. This negative response reflects investors' skepticism about project synergies being captured. Alright, so let us look now at mergers, acquisition, takeovers. What are the differences? So a merger. Two firms agree to integrate their operations on a relatively co-equal basis. Pretty much, 50-50. There are few true mergers because one firm usually dominates in terms of market share, size, or asset value. An acquisition now is when one firm buys a controlling or a 100% interest or stake in another firm with the intent of making the acquired firm a subsidiary business within its portfolio. A takeover now is a special type of acquisition strategy where the target firm did not solicit the acquiring firm's bid. And most of the times this is hostile, like a hostile takeover now is an unfriendly takeover that is undesired by the target firm. The rationale for this strategy is that pre-announcement returns of hostile takeovers are largely anticipated and associated with a significant increase in the bidder's and target share price. Now, there are multiple reasons for acquisitions, and there are also problems in achieving success with acquisitions. So we're going to look at them. So reasons for acquisitions are increased market power, overcoming entry barriers, cost of new product development, lower risk, increased diversification, reshaping the firm's competitive scope, and learning and developing new capabilities. So we will look at the reasons for acquisitions first, and then later we will look at the problems in achieving the success of these acquisitions. So first, let us look at market power, increased market power. Market leadership results from market power. The factors that increase market power are the ability to sell goods or services above competitive levels. The cost of primary or support activities are below those of the competitors. The size of the firm, resources and capabilities to compete in the market and share of the profit, and also to purchase a competitor, a supplier, a distributor, or a business in a highly related industry. Market power is increased by horizontal acquisitions, where you acquire a firm in the same industry. For instance, McDonald's successfully acquired Boston Market. Vertical acquisitions now, suppliers or distributors are acquired along the same value chain. For example, Walt Disney Company acquired Fox Family worldwide. And then there are related acquisitions where firms acquire other firms in related industry, but not necessarily the same, along their same value chain. So it's not really vertical or horizontal, but is a related industry. Horizontal acquisitions. The acquirer and acquired company compete in the same industry. The firm's market power is increased by exploiting cost-based synergies and revenue-based synergies. Acquisitions with similar characteristics result in higher performance than those with dissimilar characteristics. So, similar characteristics are strategy, managerial types, resource allocation patterns, previous alliance management experience, so that when you acquire the other firm, basically you can share activities, etc., and transfer competencies and those things, usually in horizontal acquisitions. For vertical acquisitions, it is the acquisition of a supplier or distributor of one or more of the firm's goods or services. It increases a firm's market power by controlling additional parts of the value chain. And we have done vertical integration, so we know what that is. Now, for related acquisitions, it is the acquisition of a company in a highly related industry. Value creation takes place through synergy that is generated by integrating resources and capabilities. So because of the difficulty in implementing synergy, related acquisitions are often difficult to implement. So the horizontal, vertical, and related acquisitions are acquisitions that intend to increase market power, but they are subject to regulatory review and analysis of financial markets. Now, another reason for acquisition is overcoming entry barriers. So entry barriers now are factors associated with the market or with the firm operating in it that increase the expense and difficulty faced by new ventures trying to enter the market. This way you can earn economies of scale and you can also differentiate your product. Now we also have cross-border acquisitions, where these are acquisitions made between companies with headquarters in different countries. They are often made to overcome entry barriers, and they can be difficult to negotiate and operate because of the differences in foreign cultures. For cross-border acquisition, again, in the current global competitive landscape, firms from other nations may use an acquisition strategy more frequently than firms in North America and Europe. The strategic focus underscores the different approaches to cross-border acquisitions by Chinese, Indian, and Brazilian corporations. Another reason now is the cost of new product development and increased speed to market. The internal development of new products is often perceived as high and risky, so the acquisition allows a firm to gain access to new and current products that are new to the firm. Compared with internal product development, acquisitions are less costly, they have faster market penetration, and they have more predictable returns due to the acquired firm's experience with the products. Also, we have lower risk compared to developing new products, and this is another reason. The outcomes of an acquisition can be more easily and accurately estimated than the outcomes of an internal product development process. Acquisition strategies are a common means of avoiding risky internal ventures and risky R&D investments. Acquisitions may become a substitute for innovation and thus should always be strategic rather than defensive in nature. Another reason is increased diversification. So using acquisitions to diversify a firm is the quickest and easiest way to change its portfolio of businesses. Both related diversification and unrelated diversification strategies can be implemented through acquisitions. The more related the acquired firm is to the acquiring firm, the greater is the probability that the acquisition will be successful. Another reason, reshaping the firm's competitive scope. So an acquired firm can reduce the negative effects of an intense rivalry on a firm's financial performance. So to reduce a firm's dependence on one or more products in the market, a firm may acquire another firm. Also, reducing a company's dependence on specific markets alters the firm's competitive scope. Companies also acquire other firms because they want to learn and develop new capabilities. An acquiring firm can gain capabilities that the firm does not currently possess. They may need special technological capability, they want a broader knowledge base, or they want to reduce inertia. Firms should acquire other firms with different but related and complementary capabilities in order to build their own knowledge base. So we just looked at the reasons why companies acquire others, or why they use the acquisition strategy, but there are problems associated with acquisition strategies. There's difficulty in integrating, inadequate target evaluation, large or extraordinary debt, inability to achieve synergy, too much diversification, mergers overly focused on acquisition, and sometimes the acquisition or the diversification strategy just becomes too large. So acquisition strategies are not problem-free, even when pursued by for value-creating reasons. So research suggests that 20% of all mergers and acquisitions are successful, 60% produce disappointing results, and 20% are clear failures, with technology acquisitions reporting even higher failure rates. Greater acquisition success accrues to firms being able to select the right target, avoid paying too high a premium by doing appropriate due diligence, integrate the operations of the acquiring and target firm effectively, and retain the target firm's human capital, as illustrated by Facebook's approach described in the opening case. Alright, so let us look at integration difficulties now. So integration challenges include melding two disparate corporate cultures. So the corporate cultures are so wide and different that it is hard for you to integrate the different cultures from both firms. Linking different financial and control systems. Building effective working relationships, particularly when management styles differ. Resolving problems regarding the status of the newly acquired firm's executives, and the loss of key personnel, weakening the acquired firm's capabilities and reducing its values. So those are integration difficulties. Inadequately evaluating the target now is about a company probably not properly doing their due diligence, and the due diligence is the process of evaluating a target firm for acquisition, and ineffective due diligence may result in paying an excessive premium for the target company. Evaluation requires examining the financing of the intended transaction, the differences in cultures between the firm, the tax consequences of the transaction, actions necessary to meld the two workplaces, both the accuracy of the financial position and accounting standards used, and the quality of the strategic fit, and the ability of the acquiring firm to effectively integrate the target. Another problem associated with acquisition is large or extraordinary debt. So a company may have junk bonds, and these are financing options whereby risky acquisitions are financed with money, that is debt, that provides a large potential return to lenders, that is the bank, bondholders, etc. High debt can increase the likelihood of bankruptcy. It can lead to a downgrade of the firm's credit rating. It can preclude investment in activities that contribute to the firm's long-term success, such as research and development, human resource training, and marketing. Another reason now another problem in achieving acquisition success is the inability to achieve synergy. Synergy now is when assets are worth more when used in conjunction with each other than when they are used separately. The synergy is created by the efficiencies derived from economies of scale and economies of scope by sharing resources, that is human capital and knowledge, across the businesses in the merged firm. Firms experience transaction cost when they use acquisition strategies to create synergy. Firms tend to underestimate indirect cost when evaluating a potential acquisition. Now we have private synergy, and this is when the combination and integration of the acquiring and acquired firms' assets yields capabilities and core competencies that could not be derived by combining and integrating either firm's assets with another company. So the advantage here is that it is difficult for competitors to understand and imitate, and disadvantage is that it is also difficult to create this private synergy. Companies may also get involved in too much diversification. Diversified firms must process more information of greater diversity. Increased operational scope created by diversification may cause managers to rely too much on financial rather than strategic controls to evaluate business units' performances. Strategic focus shifts to short-term performance. Acquisitions may become substitutes for innovation. So this now is where companies over-diversified. Now we spoke about related diversification last unit. So related diversification requires more information processing than does unrelated diversification. So due to the additional information processing, related diversified firms become over-diversified with fewer business units than do unrelated diversification. Over-diversification leads to a decline in performance, after which business units are often divested. Even when a firm is not over-diversified, a high level of diversification can have a negative effect on its long-term performance. Also, managers themselves may overly focus on acquisitions. Why? More fun to make the deals than to run the company. Managers invest substantial time and energy in acquisition strategies in searching for viable acquisition candidates, completing effective due diligence processes, preparing for negotiations, and managing the integration process after the acquisition is completed. And sometimes the managers are focusing so much on the acquisition and they're not spending enough time running the actual companies or business. Managers in target firms operate in a state of virtual suspended animation during an acquisition. Executives may become hesitant to make decisions with long-term consequences until negotiations have been completed. The acquisition process can create a short-term perspective and a greater aversion to risk among executives in the target firm. And a group of companies may just become too large. So additional costs and complexity of management may exceed the benefits of the economies of scale and additional market power, creating diseconomies of scope. More bureaucratic controls result from size. Formal rules and policies ensure consistency of decisions and actions. Formalized controls often lead to relatively rigid and standardized managerial behavior, and the firm may produce less innovation. So let us talk a little bit about now effective acquisitions, because we have it had said about 20% of acquisitions are successful, and more than likely they follow these steps in terms of, or these were some characteristics of criteria that happened with the acquisition. So for acquisition to be effective, the acquired firm has to have assets or resources that are complementary to the acquiring firm's core business. The result is high probability of synergy and competitive advantage by maintaining strengths. The acquisition should also be friendly. The result is that it is faster and more effective integration and possibly lower premiums. Also, acquiring firm conducts effective due diligence to select target firms and evaluate the target firm's health, which is financial, cultural, and human resources. The result of this is that firms with the strongest complementarities are acquired and overpayment is avoided. Number 4, acquiring firms has financial slack. They have extra money, so they're in a favorable debt position. The result is that financing is easier and less costly to obtain. Also, a merged firm maintains low to moderate debt position. The result is that they have lower financing costs, lower risk of bankruptcy, and avoidance of trade-offs that are associated with high debt. Then, the acquiring firms have sustained and consistent emphasis on research and development and innovation. The result of this is that they would maintain long-term competitive advantage in markets. And finally, the acquiring firm manages change well and is flexible and adaptable. The result of that is that it will be faster and more effective integration, which will facilitate the achievement of synergy. So just to look quickly at some effective acquisition strategies. So the firm want to make sure that when they're acquiring other firms, they have complementary assets and resources. So because buying firms with assets that meet current needs build competitiveness. Also, you want to make sure that your acquisitions are friendly, as friendly deals make integration go more smoothly. You also want to make sure that the firm also want to make sure that they conduct due diligence and they have a careful selection process, because deliberate evaluation and negotiations are more likely to lead to easy integration and building synergies. And lastly, you want to buy firms that the buying firm have to maintain financial slack. And this will provide enough additional financial resources so that profitable projects may be capitalized upon rather than foregone. So some attributes of effective acquisition strategies are that you will have low to moderate debt. The result is merged firms maintains financial flexibility. The attribute is sustained emphasis on innovation, and the result is that the firm will continue to invest in research and development as part of the firm's overall strategy. And also another attribute is flexibility. And the result is that the firm will now have the experience at managing change and is flexible and adaptable. Alright, so we're going to turn our attention now to restructuring. So we looked at mergers and acquisitions, primarily acquisitions, because remember we said that there are no true mergers. So we look primarily at acquisitions, the reasons and the difficulties, etc., etc. So now we're looking now at restructuring. And for instance, when a firm acquires a new firm and they decide that they are going to restructure it. And also remember that when we did diversification last week, they could also restructure a firm and sell it back in the open market. So restructuring is a strategy through which a firm changes its sets of businesses or financial structure. Failure of an acquisition strategy often precedes a restructuring strategy. Restructuring may occur because of changes in the external or internal environments. Restructuring strategies are downsizing, downscoping, and leveraged buyouts. Downsizing is the reduction in the number of a firm's employees and in the number of its operating units, but it does not change the essence of the business. Downscoping now refers to divestiture, spin-off, or some other means of eliminating businesses that are unrelated to a firm's core business. Leverage buyout now is when a party buys all of the assets of a business, financed largely with debt, and takes the firm private. Downsizing now is tactical, it is short-term, cuts labor, acquisitions failed to create anticipated failure, or you paid too much for the target. So these are the reasons also why you may downsize. Downscoping now is very strategic and it is long-term. It focuses on the core business and it has more positive effect on the firm's performance than downsizing. Downsizing really is a reduction in the number of the firm's employees and sometimes in the number of its operating units. It may or may not change the composition of businesses in the company's portfolio, but the typical reasons for downsizing is that expectation of improved profitability from labor cost reductions and also the desire or necessity for more efficient operations. Downscoping, as we said before, is a divestiture, spin-off, or other means of eliminating businesses unrelated to a firm's core business. A set of actions that causes a firm to strategically focus on its core businesses and reduce the diversity of its business portfolio is the downscoping. It's what downscoping does. It may be accompanied by downsizing but must avoid eliminating key employees. Smaller firms can be more effectively managed by the top management team. Just a note about downscoping and globalization. US firms use downscoping more frequently than do European companies. Conglomerate building has been the trend in Europe and Latin America and Asia. Some Asian and Latin American conglomerates have begun to adopt Western corporate strategies, that is, refocusing on their core businesses. Downscoping has occurred simultaneously with globalization and the market liberalization, which have greatly enhanced competition. Leverage buyouts. One party buys all of a firm's assets in order to take the firm private or no longer trade the firm's shares publicly. So a private equity firm now is a firm that facilitates or engages in taking a public firm private. It is this means that, for instance, when we did the last unit about diversification, and I was saying that sometimes when the firm is effectively allocating their capital market, they may also buy back stock. Sometimes a firm not only want to buy back some stock, but they want to buy back all the stock that they have sold to anybody to take back the firm private. So it's no longer a public company. So significant amount of debts may be incurred to finance the buyout, and the immediate sale of non-core assets to pare down debt can correct for managerial mistakes. Managers making decisions that serve their own interests rather than those of shareholders can eliminate that by doing leveraged buyouts. So there are three types of leveraged buyouts. We have management buyouts, employee buyouts, and whole firm buyouts. Management buyouts more so than the employee buyouts and whole firm buyouts lead to downscoping, increased strategic focus, and improved performance. So why we have the leverage buyouts now? Protection against a capricious financial market allows owners to focus on developing innovations and bringing them to market, and it is a form of firm rebirth to facilitate entrepreneurial efforts. Leverage buyouts are considered a significant innovation in the financial restructuring of firms. However, they can involve negative trade-offs. So first, the resulting large debt increases the firm's financial risk, as is evidenced by the number of companies that filed for bankruptcy in the 90s after executing a whole firm buyout. A short-term and risk-averse managerial focus results in these firms failing to adequately invest in research and development and other core competency drivers. Most leverage buyouts have been completed in mature industries where stable cash flows are possible. Restructuring outcomes. Now, restructuring outcomes are for the short term, it reduces costs, labor, and debt. The emphasis is on strategic controls. For long-term outcomes, we have a loss of human capital, performance may be either higher or lower, and of course there's also higher risk. So, this is just a graphic to give you a synopsis of the restructuring of companies. We have downsizing, downscoping, and leverage buyout. The short-term outcomes, which are reduced labor costs, reduced debt, emphasis on strategic controls, and high debt costs. And long-term outcomes are the loss of human capital, lower performance, or higher performance, but definitely higher risk. Okay, so that is it for this unit. Make sure you read the chapter in the text, because then it will make a lot of the concepts here a little bit more clearer, and then you complete the tutorial sheet and come to class prepared. Okay.